Deven Choksey is with us, managing partner at DRChoksey Finserv. Deven, good to have you with us here. Thank you for your time. Yesterday, the top gaining sectors were what? I mean, actually, all sectors were in the green. Top of the list were sectors like autos, which have been beaten down because of that sort of, possible exemption, etc. Tata Motors and so many auto-anked names which did very well. Metals, of course, interest is starting to come back. Stocks have gotten smashed. So let's just start with those two. What do you like there, Deven?
Good morning, Prashant. Well, certainly, I think the internal fundamentals of these companies, they remain absolutely convincing and strong. For most of the auto companies, the domestic demand scenario remains, I think, relatively more comfortable. The exports, yes, of course, I think in a way, if the tariff-related issues come in the way, some part of the impact could come, but which I believe that it could last only for 3 to 6 months, after which it could probably get normalized. That's what our take would be. But let's not calculate that part now, because we are still 90 days away from that activity, if at all the tariff is implemented. So we remain relatively more confident about the domestic story of Indian auto companies. And particularly, we believe that electric vehicles are the ones, I think, which are shaping up the new demand scenario in the country. So companies with the portfolio of electric vehicles are expected to relatively do well. Some of the ancillary companies are expected to do well on two counts. On one side, the input cost, I think, remaining under control, thanks to the lower gold oil price, lower commodity price, and the lower impact of the currency as well. I think that is basically working well for some of the input costs for the auto ancillary companies. And that's where you like to position the companies like Minda, Minda or Minda Power, for that matter, I think, in the portfolio. We believe that I think overall environment should remain relatively positive for both metals as well as for the auto ancillary sector in general.
Okay, all right. Hi, Deven. Good morning. Good to see you in. What about banks? Phenomenal run is what we have seen out there. And the big boy, HDFC Bank, massive delivery-based buying is what we saw. They have cut their savings rate as well yesterday, and they had some room to do that. So the cost of funds will fall, and that's why, most brokerages are estimating 5 to around 7 basis points increase in their NIMs in the first quarter of FY26. Your view on this one? It didn't perform on the way up, but now, in fact, that's fine, coming back into its own. HDFC Bank.
Yes, Nigel, good morning. Well, it's catching up well. I think on one side, the liability cost, I think, is coming down, which is a good point. And at the same time, the prospects of improvement in the NII, NIM, particularly, I think, is more important. We believe that the larger banks like HDFC and SBI would be relatively in a better position, also because of the fact that the credit growth is remaining in the vicinity of around 16 to 18% in general for these banks. And that's where probably I think you are likely to see the better profit performance coming in. We do like, I think, the likes of Kotak in the portfolio, or even for that matter ICICI, because I think they're positioning well with their different lending portfolios, be it retail or the corporate side of the activity. I think they are well balanced. So we believe that I think there is an opportunity to make money into these companies, close to around 10-15% kind of upside can't be ruled out, including some of the larger NBFCs like Bajaj Finance. I think the conviction is relatively on higher side.
Deven, good morning. I also have a bank question for you today. IndusInd Bank, because now the numbers are finally official and the hit is just less than, just a little south of 2,000 crores. So the uncertainty in that sense is out of the way, though our colleagues are reporting that there could be some senior level management exits as the RBI continues to take stock of what happened. The stock is obviously at a very, very deep discount. It's just 20% off its 52-week low. What would you advise on IndusInd?
Yes, good morning. Well, maybe some kind of re-rating is not ruled out in this kind of a scenario, given the fact that the liability part is known already now, so that is getting discounted into the price. And that's where probably some contra buying, some amount of support buying can take place in the portfolio of funds who have been holding onto this particular stock. Maybe I think it's a time to trade in, trade out, where you are buying at lows and probably selling it out at higher level. As I see it, I think the stock could get re-rated, but at the same time would trade in a range. And it could possibly, I think, fluctuate in that particular range for some longer period of time.
Okay, all right. Point taken there on IndusInd. I mean, big move, right? And by the way, the stock opened just 10 rupees higher. And yesterday was a big gap up for the market. Yesterday it opened 10 rupees higher, and then, I mean, everything else came later. And the high was made at about 12 or so in the afternoon. About 7% up is what we finally closed at on IndusInd Bank yesterday. What else? Deven, I don't know. I'm not sure if you track some of these mid-cap names which saw very large moves. I'm just going to throw these names and come in if you have a view. Fino Payment was a big volume-led mover yesterday. There was Intellect Design, which went up very sharply. Mazgaon from the defense space was a sharp mover.
Yeah, Prashant, I believe that I think some of these names probably will have the tendency to go up largely because of the follow-up buying taking place into the portfolios of the investors. Not completely sure about the valuation at this point of time in these cases. But yes, I do agree on one aspect that when the market punished some of the quality mid-caps in the price fall, I think with the confidence coming back into the market, they are likely to find a buying into these counters. And that's where I think we remain selective about the quality of the companies, the fundamentals of the companies, by adding them to the portfolio in the mid-cap space. We are not typically going after the momentum at this point of time because we believe that there are too many moving parts currently floating around, which probably I think would create some part of the risk in the portfolio if you chase momentum at this point of time. So we stay with the quality fundamentals and even mid-caps that we have in the portfolios.
All right.